Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's go over to another interesting story today in the tech space. That's TikTok. It needs to be divested. The U.S. operations looks like there are some buyers out there. Now the question is, what are they going to pay for it? Mandeep Singh joins us. He's a senior tech analyst at Bloomberg Intelligence. Mandeep, I saw the reporting this morning from Bloomberg about a $14 billion valuation, and I was saying, what? Isn't it worth multiples of that? But then I see that there might be an arrangement where ByteDance is going to receive a lot of the profitability of the U.S. operation. What's the latest that you know?
So that profitability option is tied to the fact that, ByteDance still has to run the operation. So what they have done is created two separate entities. One entity will house the data. It will control the content and the algorithm. So they are going to recreate the algorithm. And that other entity that ByteDance is responsible for will actually run the day-to-day operations. And, it will be responsible for showing the ads, any e-commerce that flows through TikTok. And so from that perspective, it makes sense that they will keep half of the profits because guess what? A company like Oracle, yes, it can run the infrastructure, the app, but it doesn't have the expertise to, run the ad operations or do e-commerce. At the end of the day, it's more infrastructure than applications. And so from that perspective, it makes sense that, ByteDance is involved in running the operations.
And we've also learned today that ByteDance is expected to get about 50% of TikTok US's profit under this potential Trump deal. What do you make of that? This, again, is according to Bloomberg reporting. It has not been confirmed, and we all are waiting for things to be made official. Does that sound like a reasonable split?
I mean, think of it this way. Oracle was getting paid, let's say, TikTok US was generating about $10 billion in revenue. Oracle was getting paid $2 billion just for hosting the app and, storing the data. So it was a revenue generator, the TikTok contract for Oracle. Now that Oracle owns TikTok US, that revenue gets converted into a cost. So, and it could be at least $1 billion in cost. So from that perspective, the fact that Oracle went from $2 billion in revenue from TikTok to, having $1 billion extra in cost, it makes sense that they should get some sort of a deal when it comes to buying the asset. And so that's why that low price tag of $14 billion that everyone is surprised about, there's a reason for that. Because, if Oracle has to own this thing, they need to have some sort of incentive because it's a $3 billion delta to their gross profit.
All right. So just to be clear here, what will these new investors, what will they be buying? And is what they're buying, is that $14 billion seem reasonable to you?
Yes. So my other minority investors, whether it's Silver Lake, and we still don't know all the minority investors who are involved here, but clearly, I imagine they're not responsible for the day-to-day operations. And if TikTok US was generating about $10 billion plus in ad and e-commerce revenue, that's why they want ByteDance to continue owning those operations, running those operations, because they don't want that $10 billion to go to, $5 billion over the next 6 months. And so that's why they are getting that 45 or 50% of profitability for TikTok US, even though they'll become a 20% owner of the TikTok US asset after this.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
The president has planned to impose a 100% tariff on branded drug imports. He talked about this most favored nation status for U.S. consumers. Drug companies, of course, are up in arms, and they've been trying to find ways to to get around it, to get an exemption. So let's bring in Sam Fazeli. He is Director of Research for Global Industries and Senior Pharmaceuticals Analyst for Bloomberg Intelligence. And Sam, the reporting that our colleagues over at Bloomberg News have done indicate that the drug makers are not all that concerned about this tariff plan for pharmaceutical companies because they have all made plans to invest big time in the U.S.
They have indeed. And, Scarlet, this has been something that's been going on for since the announcement of we're going to punish you somehow, tariffs, most favored nation, or whatever other mechanism that's been put forward, unless you bring your manufacturing here. So it's the same rhetoric, it's the same story. And some of the companies have pledged, we were just adding up, we just published the list of things that pharma companies have said, 50 billion here, 45 billion there, 60 billion there, numbers at least, and they look good on a piece of paper. And a lot of them already have manufacturing there. Some of them have started making new sites. Maybe they would have done it anyway because you need manufacturing for the new products that you have because they're slightly different, etc. But I think the reason you see pretty much everything's green on my screen in the large pharma land, except for Novo Nordisk, the top performer is Glaxo, which is the UK market is still open actually. So I think it's because of that. It's because people know, well, actually, this isn't going to happen. 100% tariff is not going to happen because they've done what the president is looking for.
Sam, what is all this just generic? I mean, just all this talk about tariffs on pharmaceuticals, the restricted funding to American universities. In your circles, where people are working day in, day out, trying to develop new drugs, new therapies, what's the feeling in that community?
The feeling is thorough confusion. Because on the one hand, you want skilled workers in these skilled jobs in the US. On the other hand, you're not allowing them to come from overseas. I don't know how many hands I need here. On the other hand, I'm going to borrow your hand, Paul. We've got the situation where we have science that's being defunded to a degree. Now, we have to be careful there because there's particular pressure on certain types of research, certain types of science. But the National Science Foundation, the NIH, those are all the sources of these PhDs and biomedical engineering that are required to run these manufacturing facilities. They're being impacted. So what happens over the long run, if you can't bring the workers from overseas because of the H-1B visa issue, if you can't generate them internally, what happens in 5 or 10 years? Who's going to run these places? Therefore, confusion. So this, I'm trying to get my head around, is the US still for innovation or against innovation? I don't know what the answer to that is.
Seems like we're for innovation, but everyone here doing it has to be American. I don't know. That might be one interpretation of it.
But Scarlett, I buy that, and it has been the case. And you have some of the most innovative, some of the best people there, no question about it. But you still need the basic science and the funding to get them to that bachelor's degree, master's degree, PhD degree, to become the experts to continue to run these things. That's where I'm getting a bit confused. Maybe it's just me.
It's been explained to me by someone who runs a major university medical center that has a very large research capability, that it's roughly 2/3 of the funds come from the U.S. government and 1/3 comes from the university and other private sources. And that's kind of been in place for 80 years, that structure. And one could argue that structure has worked pretty well for humanity. Is there a belief that that's at risk?
I think there is. You might want to listen to some of my podcasts recently. I did one with Elias Zerhouni on the Vanguards of Healthcare podcast. I did one with the CEO of Mark Foundation, who are the people who have either been involved in running the NIH, running R&D centers, that's Elias, or the Mark Foundation, who does finances very early stage translational cancer research. They are all seeing it happen around them. And of course, they are the sorts of people who can, to a degree, fill the gap. But you're dealing with billions of dollars. We need the philanthropy monies from the top 10 folks to come in to fill this gap that the NIH budget cut is leaving, the NSF budget cut is leaving. That's where I'm worried. And maybe unfairly, maybe it all comes out and people are still able to fund the research that leads to the innovations that we're looking for. My fingers are crossed. I hope that's the case.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Boeing is one of the big gainers here, and there is a report that the company will regain more powers from regulators to conduct final safety checks. This is initially reported by the Wall Street Journal. The FAA has since come out and made it clear that this is the plan starting September 29th. So let's bring in George Ferguson. He is our go-to authority on aerospace. He's the Senior Aerospace, Defense, and Airlines Analyst for Bloomberg Intelligence. George, it would appear that this is big news given the stock market reaction. Was it unexpected? Was it expected?
You know, I think it was expected, but I think you always breathe a sigh of relief when it actually happens, right? Boeing needs to have this cap lifted, the production cap lifted, in order for it to push to higher build rates next year. That's a big part of the turnaround strategy, right? That means building more airplanes, diffusing their high overhead costs over more built. That means better cash generation, better profitability. Everything hinges on them cranking up build rates. And so I think if you're an investor in the stock, you're, again, breathing a sigh of relief because this is one obstacle, maybe had a little bit of a difficult time sort of cuffing. And it seems like the FAA is comfortable. And I think it's a good sign. It means the FAA must see progress in quality and stability in builds. And so I think if you're an investor, I think you breathe a sigh of relief when you see it.
Yeah, I'm calling it. I'm calling this thing has turned, George. I think they've finally gotten all the bad stuff behind them here. Hopefully that continues to play out. George, when they're making deliveries these days, how much is out of existing inventory versus coming right off the line?
Yeah, it bounces around month to month, but I think in the last month we saw 5 or 6 airplanes at least that we think came out of inventory. What we typically look at is we look at first flight date, and if there's a first flight date on the airplane that's prior to 2025, we're pretty sure it's coming out of inventory. So the majority are going through the factory, but again, they're getting rid of that, what they call the shadow factory, that inventory at a decent clip now. I'm hoping we hear an update during 3Q. It got a bit hard to keep track of how much inventory they had, but it seems like they're getting pretty depleted. They're running that inventory off pretty well, which would be another big positive for this company.
Well, speaking of positives, the company does report earnings on October 23rd, and these are the kinds of news events that lead to a productive earnings conference call where the management can point to all these signs of progress and talk about how they're going to move forward and build on this momentum. What are you looking for the company to say when it does hold its earnings call?
Yeah, so we would probably love to hear some targets for 2026 for build rates, for cash generation, for reduction of that shadow factory. I'm just not totally sure management's ready to give that out yet. Kelly Ortberg seems to play a little bit conservative, hold things back a little bit, but we'd love to hear what their expectations are. Right now, I think what you have in the marketplace is just a bunch of analyst views without company guidance to sort of tether some of those views on build rates. And so if you look at some of the EEB numbers on the Bloomberg terminal for Boeing, the spread is pretty wide in that. So we'd like to hear about that. We want to hear as well the defense business. Looks like it's turning around too. I think which just adds to some of the gains the company should be able to make in profitability. They won the F-47 program. We'd love to hear some commentary there too on how they're rolling off some of those fixed price contracts that have really clipped them. We think they've turned the corner there too, and defense ought to be profitable and cash generative going into 2026 too. So love commentary on that.
George, one of the headwinds you called out for Boeing over the last several years is the the lack of enough skilled laborers to get these planes off the assembly line. It's a lot more complicated than building an automobile. You pointed out, and during the pandemic, a lot of high-skilled industries lost some of their high-skilled people, and that certainly includes the aerospace industry. What's the status of that as the industry looks to continue to rebuild?
I mean, I think it's improving, right? And I think one of the things you can look to is the job situation in the country, in the U.S. is definitely switched up from the world where there were more job opportunities than there were job seekers. We've turned that around to now there's more job seekers than opportunities. That's not so good for the workers, but it is good for the companies. I think it means more stability. You don't have people that join Boeing or, more importantly, join their suppliers and then have a bid away pretty quickly, get trained and leave, because training in aerospace takes a while. So you invest in a person, and to have them stick around for 6 months and leave means you never really get the productivity, and you even probably knock down some of the productivity of your existing workers to train them. So I think that's an indicator that their labor force is probably going to become more stable. And like I said, I think Boeing will offer a wage and a benefit package that pulls people into that business. Mm-hmm. There's a lot of people, I think, coming to these businesses, to aerospace, that hadn't done this work before because there was a lot of baby boomers that retired. The more concerning part is the supply chain and the backfill in the supply chain. And I think, again, this indicates that we're getting more stability. The FAA confidence indicates to me there's more stability in that supply chain. And given this change in sort of the labor supply demand situation, I think it bodes well for keeping those people and improving productivity in the business.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.